Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I am Whitney Elkins-Hutten. I'm the Director of Investor Education at passiveinvesting.com. And if you're just joining us, which I know several people are still filing into the chat room right now, this is a live show where we take a deep dive into various topics related to passive real estate investing. So not only can you learn about the different areas of passive investing and asset classes, but take this action and confidently go into your first or next investment with us here at passiveinvesting.com. So just a quick little update. Be sure that you've registered at passiveinvestingwithwhitney.com for future masterclass sessions to see our open deals. And if you'd like, schedule time with me and we can just talk about all things real estate and how we can help you here at passiveinvesting.com. Anyways, I just want to welcome two very special guests, Chris Bennett and John Allen, our self-storage managing partners here at passiveinvesting.com. Chris and John, please take a moment to introduce yourself and your role here at passiveinvesting.com.
Sure, that works. Hey guys, I'm Chris here at passiveinvesting.com. I got my start in real estate back in 2007 during the last Great Recession, which was a very interesting time. We could talk about that a little bit. Fast forward, I went to school at UNC Chapel Hill and graduated, worked for a company over in the Raleigh-Durham area, sourcing deals on the multifamily side. We pivoted to self-storage. We started a fund. It was very successful. I moved back to Charlotte, where we were from originally. My wife and I, her family was here and all that. So I live in Charlotte, North Carolina. We have 3 boys. I partnered up with John, I don't know, like 2-3 years ago, something like that. And then he and I joined up with passiveinvesting.com to lead our self-storage team. I'm responsible on the team. I'm responsible for broker relations, sourcing deals, kind of keeping our pipeline full and part of the overall strategy as well. So that is my story in a really brief nutshell.
That is a nutshell. Thank you.
It is. Yeah, no problem.
Yeah.
John, what about you?
Yeah. So as Whitney said, I'm John Allen. I also co-lead the team with Chris here. So my background is public accounting. So I worked for a CPA firm for about 10 years. From there, I got a job with a family office. I was wearing a few different hats there. I was their CFO and their kind of all things real estate person. They invested in a lot of commercial real estate. So I was running the acquisitions, the development, the asset management over there. And like Chris said, partnered up with Chris about 3 years ago. And he told you the story about how we partnered with passiveinvesting.com. So that's me in a nutshell. I always say, if you want the words, you can talk to Chris. If you want the numbers, you can talk to me. So I do all of our underwriting and the debt placement and all of that sort of thing there. So that's the way it works.
Oh, awesome. Well, we've got several questions for you guys today. But, most listeners here are, into passive real estate. Either there are multiple deals in or they're just starting out. But we're really here to talk about the actual state of the self-storage market. Because things have changed over the past few months. I don't know who can go through life right now and have escaped the headlines that inflation's 9.1%. That we're heading towards a recession if we're not already there already. And so, if you're paying attention to all that news and media, it's pretty scary times. There's blood in the streets. But I want to actually talk about the self-storage market and where it is today. And then also, what are we doing on this side of the business to respond to that market and what we're seeing there? So could you two just first kind of comment, where are we today compared to where we were last year in the self-storage market?
Yeah. So at a high level, as far as we'll put rates and all that stuff, the Fed aside for a quick second, we can come back to that and how that's actually affecting things. But let's focus on just the business of self-storage. It's actually doing really well. You can look at data. So not just me and John telling you it's great. You can look at data from yardimatrix.com. Yardi is a software provider, kind of like some of you might be familiar with CoStar and like apartments.com. Yardi is like that on the self-storage side. They put out data monthly. They do a quarterly update. And there's a few other sources out there as well on the self-storage side. And all arrows point to basically an upward trajectory on rents and occupancies. with the exception of some of the gateway metros, like maybe think of San Francisco, New York City, Chicago, other places where people are generally speaking migrating out of those areas, and to places like maybe Austin, Texas, Nashville, Tennessee, Charlotte, North Carolina, so on and so forth. So overall in the primary and secondary markets, storage occupancies have held steady, rates have held steady and increased over year, month over month. Let's call it an average year over year, about 5 to 10%, depending on the market that you're looking at. So it has performed really well. And this goes along with the data on self-storage. Anybody watching us now can go to REIT.com and download the data from the publicly traded REITs out there and kind of do your own analysis. But the punchline is that storage performs well. It performed well during the last recession, 08, 09. I should say the second to last recession, and then the last recession of the pandemic, which nobody knew what to expect during that time, right? Because how was the world going to react when we all shut down and go home? So, but it performed extremely well during both of those times, and it's that story is continuing to pan out. So, at a level, the fundamentals, what we call it, right, the business fundamentals of self-storage, renting space to people who need it, whether it be commercial or residential folks, retail people, that business is holding up really well. And then we can talk about the rate side of the business as well and how that's being affected. And I don't want to take all the thunder from John, so I don't know if you want to add anything to that, John, but that's kind of generally how we're seeing it.
Yeah, for sure. Definitely the business itself is still very strong. I can comment a little bit more on the debt side, the rates, what's going on with the Fed. So it's no secret to any real estate investor that is having an impact on deals. It seems to me that where it's hitting the most is at returns, not so much yet at actual pricing of the assets. So the pricing, what people will actually pay for a property has not really gone down too significantly, in our experience so far. What's happening is people are just buying properties at, thinner returns. So I was just talking with one of our debt brokers this morning, actually, and they're seeing some lenders that are sort of sitting on the sidelines now, which makes it a little bit tougher to get the best rate out there if you've got less competition in terms of the number of lenders that are looking at your deal. We are seeing lenders are not always buying the story now of, okay, I'm going to buy this property, look at all the other competitors. Everybody's, charging more rent than we are. So we're going to take this property, we're going to do nothing to it, but we're just going to increase rates. Well, what lenders are saying now is, okay, that's what everybody's doing. At some point, the music's going to stop there and that's not going to work anymore. So you really have to be able to sell what you are doing at a property to a lender nowadays. So there's a lot of different, nuances there that affect your financing, that affects your underwriting, that we're just sort of in an uncertain time right now from a debt standpoint.
So I want to dig in on both sides a little bit further. So let's go back to the fundamentals piece. Like what, for somebody who's just starting to question whether self-storage is a good match for their portfolio, what about the fundamentals of the business still lend it to be a very good investment or a recession resilient investment?
Absolutely. Yeah. So storage is what people need in times of change in their life. So if you think about just a common example, maybe somebody finds a new job somewhere and they're going to move. They got to potentially sell their house, buy a new house, or find an apartment or whatnot. But maybe in the interim, they put their stuff in storage. I have family members and friends who've done that numerous times. They put their stuff in storage and they usually put it in there for maybe, let's call it 6 weeks, or maybe they're expecting 2 months, in the transition period. And then they end up staying, instead of 2 months, it's 6 months. So it extends out a bit longer. Generally speaking, you have half of your tenant base at a facility with some story like that, where they end up renting a unit and they end up staying longer than they expected. Maybe about a quarter to a half end up staying about 6 months to a year at a facility, which is much longer than they anticipated. So back to the change in someone's life. So you might have someone finding a job. You have someone potentially maybe buying a house or whatever the case may be. Or on the downside, you might have someone going through a divorce, or maybe somebody passed away recently in the family. Several years ago, I was talking to a guy. He had a facility, or he had a unit for about 7 years. He was well off. He didn't need to have the unit. He could do whatever, sell the stuff, whatever. He didn't think he needed the extra space, in other words, but his father had passed away, and he could not bring himself at the time to get rid of his dad's stuff. So he put it in climate controlled storage. So presumably he can go back and visit it anytime he wanted to. So that is what happens. Change like that happens during recessions, where people might need to downsize their home, move from a 2-bedroom, 3-bedroom apartment to a 2-bedroom, so on and so forth. God forbid people lose their jobs and they have to downsize in that way, and they end up needing storage. And then you have, they call it the 4Ds: death, divorce, dislocation, which is moving, and then I forgot the last one. But then the new D is is decluttering. And so, I'm here in my home office, John, we're all in our home office, but during the pandemic, and even still, people are making space for places to work from home in their dwelling. So they need to put that stuff in storage, and we see that happening a lot more. So those fundamentals of storage and the decluttering that has been going on and is still going on with the work from home and remote work that employees are now wanting in those white collar jobs. So it pushes that demand for storage, which is very interesting. So that's the fundamentals of it. That's the driving force behind it. If anybody's watching or listening and they say, yeah, Chris, I can't understand it still because I would never use storage, I'm right there with you. I have never put anything in a unit. I have rented units because I wanted to see what the process looks like, right, with that operator or whatever. But I never even visited the property or put anything in it. I just wanted to rent a unit. So I understand I tend to throw things away, but there is a whole category of people, not hoarders that you see on TV, but list general people, your neighbors, your friends, your family, who need the space for whatever reason, and they utilize storage, and it almost becomes an extension of their home. And so that is the fundamentals there. And now that we're going into an uncertain time, potential recession, we might already be in a recession, of course, but we're going into a little bit of time of uncertainty, people kind of pulling back on stuff. Storage, again, it remains part of their kind of their life, their budget in a sense. It becomes very difficult because of that. It becomes very difficult to go, let's say we raise rents $5, that could be a 5% rental rate increase in our pro forma, but to you, it's a latte, right? And so it's really hard sometimes to call your friends and family and say, hey, can you help me move all my junk out of my 5x10 or my 10x10 or my 10x15 and take it to this facility down the road or the dump or whatever? What do you do with the stuff once you have it in there? So storage tends to have a sticky tenant base because of just the hassle of moving. And so that's part of the fundamentals. And those are the things that are still holding true.
Yeah, and the one thing I would add to that too, one reason I like storage over multifamily is we all know real estate's a good inflation hedge. With multifamily, you might have a lease that's 12 months long or 6 months long, or maybe even longer than that. But with storage, you can change somebody's rent, 30-day notice. All the leases are month to month. So you have, in an inflationary environment like we've got right now, you can adapt to that and take advantage of it much, much quicker. And like Chris said, a 5%, increase in rent will go a long way for us as investors, but it's not such a big deal for you as the tenant. So it is a more effective inflation hedge than a lot of other asset classes for that reason.
Now, let's talk a little bit about like the business plan and strategy. I mean, there's several different things that you see operators doing with self-storage in the space. So how are we responding to the environment? Are we buying just core assets, core plus, value add? Like, where are we? Are we doing expansion?
Yeah. So we right now with, like, let's say our fund two is more of a core plus type deal where you have stabilized properties. They're in the 90% physical occupancy, a little bit lower than on economic. But the point is that they're considered stabilized properties. So we have nice debt on those as far as the capital stack is concerned. So yes, they're in good markets. One of them is here in kind of the Charlotte MSA in Mooresville. Another is in the Asheville MSA, Asheville, North Carolina. If you don't know what that is, just take a look at it. It's just a little bit outside of Charlotte, about 2 hours outside of Charlotte. But those are the types of deals right now that are in our fund 2. In our fund 1, we have a mix, some of them being stabilized, some of them having a development component, which we're going through the process on that right now. So if anywhere from, we call it core plus type returns to value add returns. We're not doing any sort of ground up opportunistic where it's just dirt and we're going to go ground up on a deal. Nothing wrong with that. That's just not what we're doing right now at this time. So yeah, so there's a mix across the board. But like John was saying earlier on, it's kind of interesting because you might have a value, theoretically, a value add deal will have, you know, a little bit more risk and a little bit more return to offset that risk. But we still see people buying at almost like a core plus type return for a value add deal. And so you don't always, as far as the textbook is concerned, it should be a certain way, but in real life, oftentimes it's not that way because there is a lot of capital that's chasing and trying to find, you know, hey, where can I place capital right now? What makes sense as far as a risk-adjusted return? And a lot of operators out there like self-storage. And so we're seeing still there be that competing bidding war for deals like John mentioned earlier on. But yeah, we have a mix in there. So John, if you want to add anything to that.
No, I think you hit everything.
Well, John, I have a question for you. So where is the capital markets right now? What specific type of debt, you know, is available for self-storage? Let's maybe start there. And then what kind of debt are we securing for our deals?
Yeah, so it's very specific based on what sort of asset you are buying. So, you know, like Chris was mentioning, when this particular, or these 3 properties that we're buying with our second fund, these are all pretty much stabilized. So we are the going in coverage. So, you know, the income that's there right now that the seller has, you know, can pay our debt, you know, I don't know the exact ratio, but it's a comfortable ratio. And so when you have that, then you're dealing with like banks, credit unions, and those are generally going to be your lower interest rates. You know, you might not get as good, you know, interest only periods, but they're nice to work with because they have low pricing. They like, you know, to be relationship lenders. So hopefully you can do more deals with them. If you are doing maybe more of a value add play, something that, you know, doesn't have that in-place income that you really need, then you're going to be looking at more of a like a bridge type lender. And the trouble with bridge right now is it's very expensive. So those are going to be like floating rate loans. And the recent spreads that I'm hearing now is, so like your rate will float at, you know, say the term SOFR, you know, plus 400, you know, basis points. So for example, right now, SOFR is at about 230 today. So you're going to be paying a rate of about 6.3 to 6.8% or so if you have a bridge loan. So it's just getting more and more expensive out there right now.
Okay. So where do you see the market heading for self-storage in the next year or so?
I don't think the debt side of things affects everybody in real estate and just in life in general. So let's pretend that all things equal, that what the path that the Fed has charted holds true, and that by the end of the year, rates will be up. You know, the federal funds rate they're projecting to be at about 3.5% by the end of the year. So that means rates on debt, like what we're looking for, should jump another almost an entire point to 1.5. So if you can imagine rates being in the 7s, you know, that will affect pricing and the number of deals that come to market. So deal flow. And so if that all holds true, as far as where rates are heading into the end of this year and into next year, we should see pricing continuing to soften, which we have seen some of that already. Like some deals have come back to us from brokers saying, hey, can you guys take a look at this one and see where you come in? And that's an expectation that sellers have to be ready for. So pricing should come down. We think on the deals that are like that we've already purchased or that are, as far as the fundamentals are concerned, again, nothing really with that changes. We won't see during 2021, that was kind of a unicorn year where you had an average of like 15 to 20%. So, I mean, it was ridiculous for the REITs. I think they hit like 15, 16% rental rate increases year over year, which is obviously, we don't underwrite to that. So it's just gravy. But will we see that again? Probably not. we should see positive rent growth because again, $5 on $100 is not that much. So it shouldn't be too difficult to hit 5-ish% on your rental rate increases, which is great. But will we see 10 to 15 in the next year, 12 months from now? Probably not. But occupancies again will likely remain high in those markets where people are moving and migrating to, because we're still seeing that not as much during the pandemic, but still it is still ongoing. People trying to leave places like California and New York. And I'm from California. My wife's from New York, so we're not knocking those places, but they're kind of migrating out into a little more business friendly and climate friendly and all that stuff, better places to live. So in those markets, the fundamentals should hold strong. We should still see positive rent growth and positive occupancy. So again, that's, everything else, all things being considered, that's kind of the outlook right now. Nothing too crazy as far as deviation from that.
And John, where do you see the capital markets going for self-storage in the next year?
Well, anytime I ask a banker, where do they think rates are going to be in 60 days, they always laugh. That's sort of
I know I was putting you in an odd spot there.
Yeah, no, I'm not a banker. So, I think the obvious thing is rates are going higher, when things do tighten up like that, if we do, and, I agree with Chris that I think the outlook for specific to storage is pretty strong still. But if we do go through some sort of recession, in addition to our rates are going up because of what's happening at the Fed, there's also going to be some, contracting of actual lenders. They're, not going to give you as high leverage as they were giving you today or 60 days ago. Those kind of things. The money is going to be, from a debt standpoint, less available and more expensive.
Okay.
Yeah, and I want to add to that too. I know a lot of us, we're online, we see stuff on social media, we follow a number of people, and oftentimes the talk of recession is when you can go and buy great deals, at good pricing, et cetera, which is true. I was around during 08, 09 and all that. I would have bought everything at that time. We all would have, right? We all would have been billionaires if we had, but hindsight's 2020. I actually don't, I'm of a different opinion. Because I went through that and I saw that and how bad that was. And again, it came from real estate. So we shot ourselves in the foot in 08, 09, but it is what it is. I saw people getting evicted, lose jobs, all kinds of stuff. I actually don't want a recession. Even though storage performs well during a recession and all that stuff, I don't want that. I don't want that for the economy or for just people and individuals. So that's not our outlook on the way things are. We can't control that, but I don't want a recession. I'd rather just keep things, going the way they are. I don't mind, buying stuff at market versus buying it when it's on fire. Like when things are bad, I don't want to do that because that means that people are losing jobs. That means things are not good in the economy. So yes, there's opportunity, but at the same time, there's a lot of pain. So that's not what we look for. But if it were to happen, I think we'd be in good shape.
Mm-hmm. Awesome.
Agreed. Yeah, I don't think that's ever a good thing. I think what would be nice is if there was some sort of cooling off, is what I'll call it, because things just have been so red hot for so long. That cooling off is sort of what the Fed refers to, or people who talk about the Fed refer to as a soft landing. They have never been able to accomplish that. So I'm not too optimistic that they'll do it this time either, but yeah, I agree with Chris. It's never a good thing. Are there going to be opportunities? Maybe. But yeah, I don't think anybody is really wishing for a recession at this point.
No.
That would be, I in my mind, I think about like trying to move the Titanic, right? That's kind of like the economy. Like you can't turn it on a dime and, every once in a while you hit an iceberg, right?
They never read the book.
Analogy, but
yeah, they never read the book, The One Thing by Gary Keller. You can't do two things at once successfully. Yeah. So I don't know.
Right.
Yes.
I don't know how they're. Yeah, that's one of my favorites. So I don't know how they're going to do it, but I think we're already, just personally, I think we're already in the recession. We'll probably, who knows? We'll find out, I think next week or this week when the GDP number, or next week when the numbers come out for Q2, but we'll see.
Yeah. So Chris, you already mentioned some resources and that investors can take a look at if they want to understand, self-storage a little bit better, but also the state of the market. Could you just take a quick moment and recap those resources?
Yeah, sure. Yardimatrix.com. Yardimatrix.com. You can sign up. They have like a free e-newsletter blast that comes out every month. They do a free quarterly webinar with their chief economist, Jeff Adler. And so that's a free publication. I didn't mention, but radiusplus.com, PLUS, radiusplus.com is another one that people can sign up for. And it puts out, information on the market, et cetera. If anybody want to be more adventurous, they want to subscribe to one of the broker email lists, you can go to Argus, 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 like just Google Argus Storage and sign up for I think it's their Market Monitor newsletter. And they send out information on where the market is at and what's going on. And they're very good, actually, compared to some of the others out there. So those are a few resources. And if anybody wants to spend a little extra money and really become an expert, you can always buy the Self-Storage Almanac, and that'll tell you all about the self-storage industry, but that's a little pricey. So.
Well, and also you guys have the Self-Storage Investor Nation webinars that you do.
Yeah,
too.
I always forget about that. Yeah, I just did one today. It was an Ask Me Anything. So I always forget about that stuff. Yes, we have a webinar and we have a YouTube channel, Storage Investor Nation. You can check that out. You can always send us a message on LinkedIn or Facebook as well. My profile is public, so you can find me on Facebook. And then I mentioned REIT.com, REIT, REIT.com. Go check them out. You can download, a little hard to find, but you can download all the data on all the REITs, the returns for annual returns for all the REITs, going back to like 1980 something or whatever it was when they started tracking that information. And you can compare each asset class, multifamily, storage, mobile home parks, whatever it is you're into, and take a look at there. So.
Awesome. Well, guys, I know a lot of people are throwing questions in the Q&A box. We are going to host a little after party for everybody here that's live, but I do have one question for you guys before we wrap up the live section of our show. And what is the biggest takeaway that you want investors to get from our discussion today when it's in relation to the self-storage market?
I think they should look hard. You have a portfolio of assets you're invested in, whether it be stocks, bonds, real estate, whatever it is, and a little more risky on the maybe Bitcoin side of things, something like that, right? So you have a risk return profile. I think if you go back and look at the data that I mentioned there, especially from REIT.com, look at some third-party resources, maybe check out the Motley Fool, go to Motley Fool and just Google self-storage and see what they have to say about it, right? So don't just take it from us. It's like asking a barber if you need a haircut. Of course you do, right? You always need a little trim, but go to a third-party source and check it out as to why self-storage is recession resistant and why it's a good addition to your portfolio as an investor, something you can use to hedge against maybe some more risky assets out there that you might be invested in. So that's what I really want you to take away is go to a third-party source, check it out, do the research for yourself, and then contact us if you have any questions or want to learn more.
Awesome. Well, guys, Chris, John, thank you so much for joining me today. And listeners, you too, thank you so much for taking your most valuable resource, which is your time, and spending it not only with us here today, but investing in yourself. So I just want to encourage you, if you haven't done so already, go to passiveinvestingwithwhitney.com if you want to get access to future masterclasses, see our open deals, and just have a conversation with me. Thank you guys for joining live today.
Thanks guys. Appreciate it.